Hello, everyone. CB3 here with the weekly market update from CB3 Financial. I'm Charles Brown, the portfolio manager. We're going to talk about what happened in January, and we're going to talk about significant changes to our program's capital growth and growth in income, aka CG and GI. Stick with us. The CB3 weekly update begins now. Welcome back. January was a really volatile month, and it did give us a small gain for the month, but usually we like to see a little bit more in this because as goes January, generally that is how the rest of the year goes. So we had less than 1% in the S&P, a little bit more in the NASDAQ, but at least it was positive. So January gave us a market that looked calm on the surface, but was full of crosswinds underneath. The mega cap tech sector continued to lead, but their leadership narrowed. So fewer and fewer of these big companies are actually pushing the market higher. And that's why you saw these overnight moves that were negative, and then the buyers stepped in during the day to bring it back to a plus day. Today was a perfect example. I'm recording this on Monday, February 2nd, and overnight, it was crazy. The market was down more than 1%, and yet it finished up 0.5%. That's a really big one-day range. Rates stayed sticky, keeping pressure on rate-sensitive sectors like utilities and consumer staples. What really happened, though, was gold and silver collapsing, which kind of shook the market participants. Silver crashed more than it has in any 72-hour period in 45 years. But let's face it, both of those markets, gold and silver and even platinum, were definitely way overbought. So dividend and value factors lagged, but early on showed signs of rotation by the end of the month. Definitely a mixed picture. But for us, January wasn't about changing what worked last month. It was about positioning for the rest of the year for the next 11 months, not the last 30. And that's exactly what drove the upgrades to CG and GI that I want to tell you about. I'll be talking more about these in my next podcast, and then a lot more with graphics and explanations in the February 12th CB3 Live episode. So we upgraded capital growth because we thought that it was time to get in sync with what the market was telling us. We have been patient with our individual stock picking approach, which worked very well in 2024, 2020, 2013, many years, and keeping up with the market in odd years. Other years than the years we were just dramatically outperforming. Last year, we underperformed, and we believe, at least our data supports, that is because the Magnificent Seven and other huge mega cap companies were just hogging the performance, and when they hiccuped, the entire S&P 500 caught cold or even pneumonia. So we have decided on the core satellite approach, which means we're going to have SPY, which is the S&P 500 Index ETF, as a core holding in CG and GI, and then we will use the stocks that we have been using in somewhat smaller allocations as what are called satellites. So this is designed to capture innovation, secular growth, long-term compounding, and year after year of strong performance. We certainly want to see that. But what we know is that there can be too much correlation inside the satellite sleeve. We had a lot of high tech, and so we have thinned that out, spread the alpha, if you will, over different stocks. There haven't been enormous amounts of changes in the stock picking so far in CG, but there was more so in GI. But there were just too much concentration in a few mega cap exposures. And without us participating in CG, we do have the mega cap exposure in DS. And most of you by now have a DS account. There was simply not enough differentiation between the core and the satellite holdings. And now that is clearly drawn, right? And February is where we made this happen. So the core, as I said earlier, is anchored in SPY. That's an ETF that tracks the S&P 500. It's our stability, our beta, and our ballast, if you will. The satellite holdings, however, get a full structure refresh, trimming overlapping names to reduce hidden correlation. So what I mean by this is these satellites or the individual stocks that we have in CG and GI now, for the most part, do not appear in SPY. There are some that will overlap, but there are several that have no presence whatsoever in the S&P 500, especially in CG. So we have continued this high conviction, high signal position based on our internal scoring, and we remove positions that just weren't pulling their weight or were duplicating exposure. So we tighten the sleeves so that every name, every asset has a job and a reason to exist. And if it doesn't have it, it's gone in the next review cycle, which is monthly, as you guys know. This is the cleanest, sharpest version of CD we have put out in well over a year, certainly since 2024's killer performing year. We want to get that back for you in 2026. And we think this is the step that needs to be taken very early in the year to accomplish that. So what this means going forward for CG, and for those of you keeping up, this is version 183 of CG. There's higher clarity. You can see exactly what each sleeve is doing. There's higher efficiency. There's no wasted. There's no duplicated exposure. Higher resilience, less correlation drag, meaning the SPY or the ETF that I mentioned will track the S&P 500, giving the satellites time to do what they do, which is bring alpha over and above what the S&P is capable of producing. And a higher upside, these satellite names have a real asymmetry with the core holdings in the S&P 500. So this version of CG will run in 2026's market environment, not last year's. So what did we do to GI? Well, GI also needed a structural shift. GI has always been about durable yield, sector diversification, lower volatility, and steady compounding. Many of you use GI to pull your monthly or quarterly RMDs, and we need to have this program growing during the year so that you can have that capital appreciation, but the income generation, so that when you need to pull money out for a required minimum distribution or just income to live on, that it will be there on a consistent basis, at least on a more consistent basis than we think that it was in 2024. So I want to just shout out here to Tim at Schwab, who worked with me on the options hedging for both of these programs. We spent 90 minutes today getting these just right and tweaked for all three programs, CG, GI, and DS. Now, many of you know that I introduced this options hedging in September of last year, and we really refined how it's going to interact with the new holdings setup in CG and GI. And Tim, thanks so much for all you did today to get all of our customers exactly where they needed to be positioned with the nuance that we've approached now with these debit put option spreads in our managed program. So the new GI structure, again, we've migrated to this true core satellite frame. It'll work just like CG and DS. And remember that DS has always had a satellite core. The core for DS is the Magnificent Seven, making up more than 60% of the holdings in there. And then the rest of the assets become the satellites. And it's worked very well. If you look at our track record for DS, we're up way over 400% in 7.5 years. So this core, high quality, globally diverse income engines, and then targeted yield enhancers. So there's 4 ETFs now. There were only 3. There are 4 now in GI with tactical opportunities, and we're really excited about that. We think it gives us cleaner risk management, more predictable yield, which is income for you GI account holders, and better control over currency and region exposure. So what does this mean? GI now behaves like a modern income strategy. Yield without benchmark drift. A structure that can adapt as rates fall, rise, or stall. And this becomes especially important with the new Fed chief that Donald Trump has nominated. Do realize, folks, that the Senate has to approve this new candidate. And I don't even want to mention his name yet because we don't want to get too excited, because the Senate right now is saying they won't vote on this new nominee of President Trump's unless he drops the federal charges against Jay Powell. Politics at its finest in Washington. All right. Just crazy. So if you're a client listening today, here's the bottom line. Your portfolios are not drifting. They're being actively upgraded. We're not reacting to noise. We're positioning for this new environment where more and more of the returns of the index are returned by, no. Take 3, go back. So if you're a client listening today, here's the bottom line for you and your money. Your portfolios are not drifting. They're being actively upgraded to match the market dynamics of these big trillion-dollar companies carrying most of the returns in the S&P 500. We want to gather those. We want to solidify those for you in your accounts, but we also want to have these satellite stocks, these outperforming alpha-generating stocks to give us performance over and above the S&P 500. And we have the options, as I mentioned earlier, and have been mentioning since September, to give us downside protection should a really big market downturn happen. Now, this is important. I'm going to take a little sidebar here. So these option hedges are not designed to protect against a 2, 3, 5% drawdown, because to do that would be too expensive. These are designed if the market has a serious bear market, 20 to 25, 35% down. The last time we got that substantially was during COVID in 2020. The options would kick in and protect the downside risk in those cases. And this is why we fine-tune this options approach with Tim over at the Schwab Options Hedging Division. Really appreciated all the help from Tim today. Guys, you are really well positioned as we head into February and the rest of the year with the core engine that we have in each of these programs, the Mag 7 in DS and SPY, the S&P 500 in GI and CG. So every change we made in February has a clear, intentional purpose. CG is now more focused, more efficient, and more resilient, and GI has more steady income generation as well as tracks its benchmark more closely. That's where it is. I'll have more for you in a week. If you have questions, CB3 at cb3.com. You know my number. We will see you next time.